Is a cooling housing sector evidence of Fed success? Data from Redfin out today showing homes are selling below their list price for the first time since March of 2021. Hessam Nadji is the CEO of Marcus & Millichap. He joins us now. Good to see you, sir. So 30,000-foot view. We're going to get to commercial real estate in a moment. What are you seeing in the residential side? Are we seeing just a cooling? Is there any similarities to 08-09?
Great to be with you on the program. Thanks for having me. If you step back, the biggest difference is the fact that the system is not sick. We don't have a fractured banking system, an illiquid banking system, and way too much speculation on loans that were about to default in very, very large volumes back in 08-09. Those conditions are not present in today's market. We had this incredible surge because of the liquidity that was injected in the system, record low interest rates because of the pandemic. All of that came together, and the fact that society was changing. People were expanding their homes, moving to the suburbs because they could work virtually, all of which is very different than 08-09, but nonetheless resulted in a big surge in prices, big surge in activity, and we're now taking that away. Basically, things are coming back to earth. You see sales are down 20% year over year. Prices are still up about 10%, which is cooling, and we've just now begun a period of leveling off and correcting back to a very healthy base, unlike 08-09.
Well, Sam, you talk about coming back to earth, getting back to that healthy base. Goldman was out with an interesting note earlier this week, basically saying that the housing market downturn is going to get worse next year. We are far from reaching the bottom. When we get to that bottom, what does that look like? I guess, how big of a pullback are you expecting to see?
Well, it will be a significant pullback from the peak that we just recently witnessed in the last 12 months or so. But what we have to remember is that in the last 2 years, home prices jumped on average 20% a year, or about 40% from pre-pandemic levels. That's unprecedented. The closest we've ever seen on an annual average is the 2010 to 2019 economic cycle, where the average annual price gain was 5.7%. So it was completely unusual, very unprecedented. Therefore, it's going to be a big percentage pullback. But again, if you look at a long-term chart, we're not looking at significant declines or discounts to where we were pre-pandemic, just getting back to where we were pre-pandemic in a lot of the metros. Metros like Phoenix, Austin, Atlanta, Charlotte, they saw prices jump as much as 50% in a 2-year time period. So there will be a painful correction. But the good news is that the rental market is at an all-time peak in demand. People are opting to rent more than ever. Affordability of single-family homes has become another reason why the rental market is so strong. And we're not facing a collapse of non-performing loans, which exacerbated the problem in 08-09.
And so we're seeing that the data is showing that 1 in 5 home sellers now dropping their asking price as the market cools. Obviously, a lot of people also went into rentals while they couldn't get into some of this inventory. But where are we in this curve then of normalcy? And what are you seeing regionally as well?
Well, I believe there will be a couple of quarters of this continued adjustment in both sales and prices, as you just cited. It's not surprising to see those statistics. I think we're going to see more of them. This correction will take a few quarters before it begins to level off. The other safety net that's out there, both for housing and commercial real estate, really is the job market. We've added over 6 million jobs in the last 12 months, and people have become much more mobile because of the ability to work virtually. And so that gives the marketplace a lot of flexibility. Markets that are creating jobs, the job leaders in particular, are not going to see as much of a home price correction. And the other side of it is that the supply volume is still well below where demand has been. So we're not overbuilding both housing and commercial real estate, all of which are positives, but they don't eliminate this short-term adjustment and some pain to go from these incredible peaks we had post-pandemic to much more of a normalized market.
You mentioned that remote work, which for tens of thousands comes to an end next week as a lot of companies begin to pull back employees to the office. With that, I want to ask you about the commercial outlook, in particular in office space. Now, I know all real estate is local, but given that those numbers really have plateaued in terms of return to office, what is the outlook on the commercial and office space environment?
Sure. Well, the commercial real estate industry has so many different variations. You have apartment buildings that are part of the business, that are great investment vehicles, shopping centers, self-storage units, you have the hospitality industry, hotels, mobile home parks. It's a really diverse industry. So when we talk about commercial space, most people think of office, and of course, office is the property type that is feeling the most pain because of the fact that people are not coming back into the office. Our office clients that own buildings across the U.S. are reporting maybe 50% occupancy levels by their tenants at this time. The good news is those tenants are still paying rent because they have an obligation to. The question is what happens when those leases roll over in the next 3 to 4 years? We will see a shrinkage of footprint. We will see a shrinkage of demand. We're seeing it as we speak because of the hybrid work environment. Once we get this current uncertainty regarding how much of a recession we're going to have, are we going to have from adding 300,000 to 500,000 jobs in the last 2 months to losing jobs? We may experience some job losses actually before the Fed is done fighting inflation. And what does that do to demand? In the short term, the office space is definitely going to feel the pain. So on a longer term basis, once we get past the current recession concern and then the economic cycle follows it, you're going to see new demand. You're going to see new companies form. You're going to see new expansion plans by companies. That's probably 3 to 4 years off. And in the meantime, I think there will be a valuation adjustment and a rental adjustment.
Suburban office space has relatively rebounded, but it's those big cities that are struggling. On that note, I shot some video at the Seagram building right here in New York City, an iconic building on Park Avenue. They put $25 million into the development you're seeing on your screen. Pickleball, weightlifting, cycling, you name it, a giant theater. Is that what it's going to take, those type of amenities in those major cities?
You just nailed it. The silver lining of the pain we're talking about is the reconfiguration of the use of space, making it more experiential, and actually attracting the next generation of workers into a collaborative team environment, physical presence, because of some of these amenities. We've seen it in retail. The retail segments that are doing extremely well, surprisingly well, are those that are experiential. Post-pandemic, when restaurants open back up, fitness centers open back up, movie theaters open back up, you saw a surge of that experience desire by consumers. The same is true in the office side of the equation.
All right, Hessam Nadji, thank you so much for joining us this afternoon. We appreciate it.